The TSX still climbing up. It could hit another record close today. It's still above 29,000 at 158. Some say on the strength of base metals and energy stocks, but can it keep going? Let's bring in Benjamin Klein, Senior Portfolio Manager with Baskin Wealth Management. North American stocks generally have been climbing, hitting record highs. Is this typical at all for the month of September or the fall period at all?
Well, for us, I think it comes down to fundamentals. So first of all, of course, precious metals and gold have done extremely well, but company fundamentals and company earnings have been quite strong. Really, we're going on basically a 3-year period now, very strong continued results and stock prices climbing. So to us, it makes sense. This is not all smoke and mirrors, so to speak.
When you are planning ahead at this point, are there still tariffs concerned? I mean, the U.S. is now in the process of sorting it out in the courts. So is it something you still have to sort of keep at the back of your mind to plan around if and when those get reversed or more get added on?
Of course. So, with such a major macro event or potential event here, you have to keep it in mind. For us, our portfolio is actually, in our view, not really very likely to be significantly affected by tariffs. We don't own any manufacturers. It's not likely to really move the needle for us, except for the second level of things like banks and other financials that are going to be affected by their underlying businesses or loans being affected. So for us,
you haven't had to pivot very much?
No, not at all, in fact.
Got it. Okay, let's talk about the job numbers that have been weaker both in the U.S. and in Canada. GDP, of course, in Canada contracting. Where do you stand on the Bank of Canada decision?
Seems very likely that we're going to have rate cuts both in Canada and the U.S. at this point. Of course, how many, the magnitude of those, much more difficult to predict, and certainly going into 2026 and beyond, very hard to predict. But certainly it looks to us like the economics point to at least one rate cut here and in the U.S., and we'll see from there.
Got it. Okay, let's get to some of your stock picks then. The first one is Live Nation. There's an antitrust lawsuit in the U.S. Is that affecting the stock at all?
So for us, we actually see the Google ruling as probably a positive for Live Nation. We're not really in the business of prognosticating what's going to happen with legal rulings, but certainly this seems like, shall we say, a more friendly towards antitrust administration, and that Google ruling, again, we think is probably positive for Live Nation.
What do you like about the company?
So concert going is a surprisingly recession-resilient business. It's really one of the last things that people spend less money on as consumer spending goes down. They're much more likely to cancel things like eating out, even canceling vacations. Concert goers, they see a concert as a once-in-a-lifetime, irreplaceable experience. They don't want to cancel it. Think about Oasis at their global tour. Their show in Toronto was immensely popular and everywhere. That's the kind of thing that you can't really replace. And for us, there are a couple of reasons why we think Live Nation is really attractive, and one of them is their focus on these new vertically integrated stadiums. They're able to profit on things like not just tickets and sponsorships, but also concessions and even parking. And again, the antitrust is a bit of a specter, but we think that this is a positive for them, and it's a fabulous business with recession resilience in terms of its underlying fundamentals as well.
Okay, let's get to your second pick, which is Ferrari, which is such a niche market. I'm wondering why this is a company that you think will have some forward growth.
I think it's easy to underestimate just how powerful the brand is. And this is a company that, yes, they sell cars, but really what you're marketing is the brand. Their car models have 3-year waiting lists. And if you get on that waiting list and you get to the end, you get offered the chance to spend hundreds of thousands or even millions of dollars on a car. And of course, you want to say yes so that they ask you again next time. One really interesting thing for us is that 80% of Ferraris that are sold to people who already own a Ferrari or maybe more than one Ferrari. And what they're able to do by introducing new brand extensions, for example, they're expected to unveil their first fully electric car in this November. And also their SUV, which has been very popular, is it gives them an opportunity to sell more cars to existing owners that might want to add, they might want to add an EV, they might want to buy, for example, an SUV for their partner is very popular. So we think that there's a lot of runway, for lack of a better term, to allow them to continue to sell more cars and think long term. It's a very long term focused company.
Do they already have a hybrid vehicle?
They do, and this is going to be their first EV.
And do they do well with the hybrid?
Yeah, it allows them to not only produce new cars, but it also allows them to have less to worry about in terms of emissions requirements.
Got it. Okay, let's get to your third pick, which is Domino's Pizza. You went from Ferrari to Domino's Pizza, one end to the other. Yep. Tell me why you like Domino's. Is it also one of those things that's just recession resistant? Exactly right. So that's a big part of it. So of course, pizza is the cheapest option. I have 2 little kids, and every birthday party, there's a reason why there's always pizza.
But in terms of Domino's, they're now the biggest player in the U.S. They've been able to take market share over the last several years from Pizza Hut and from Papa John's. But still, this is a market that's dominated by small independent pizza chains. And we think that Domino's is able to, through their technology, both in store and also their loyalty program, which is able to drive significant amounts of growth and organic growth in a stagnant market. We think that they're a really remarkable business that has a long runway to continue to grow if they want to.
How have they been able to take market share? I would imagine that people who buy pizza on a regular basis want the exact same pizza they got last time. So how have they been able to sort of claw away some of those consumers?
Exactly right. So I actually like Domino's pizza. I think the pizza's pretty good, but they're not exactly competing for a Michelin star. They're competing on speed and convenience and consistency, and that's exactly what they're able to do. Whether it's through smart placements of restaurants, so they're not cannibalizing each other, but can still get places quickly and easily. It's through their great app, which is, I get notifications every day trying to get me to buy Domino's pizza, so it must work. And being able to consistently and quickly deliver pizza and deliver it well. One interesting thing about the business is a huge number of franchisees were actually used to be drivers. And because they pay their drivers, their employees of the company, as opposed to third parties, there's really good alignment of incentives for the drivers to do a good job, get good tips, and stay inside the Domino's ecosystem.
Interesting. So it's almost like buying shares of a company. When you work for the company, you're invested in it, and so you want to do well.
That's exactly right. They're thinking long term.
Got it. All right, Benjamin Klein, thanks for coming in. Benjamin, Senior Portfolio Manager, Baskin Wealth Management.